G'day there, welcome to the Money Boss channel. Today we are tackling a question that has been on lots of people's mind since we saw inflation jump so suddenly following COVID. And that is, should I pay off my HECS debt or my mortgage first? Now, whilst both are very important, in this video I'm going to give you 5 reasons why you might want to prioritize your mortgage over paying off your HECS debt. So let's jump into it. G'day there, my name is Phil McGilvray. I'm a financial coach, financial wellbeing consultant, and founder of the Money Boss movement, where we make practical, life-changing financial education both understandable and accessible for everyday people so that you and your family can thrive financially. So let's start with reason number 1, and that is interest rates. Now you can see on the screen here, I've got a very simple chart that shows in red, so the red line is the average discounted mortgage rate over the last 10 years. And in blue, we've got the HECS indexation rate over the last 10 years. Now you can see that at no point along this journey has the HECS indexation rate been higher than the mortgage rate. Typically, there is about 1.5 to 2.5% difference between the two. Yes, it did close a little bit just following COVID because of inflation spiking, but you can see in the couple of years since then, that normal gap has resumed at around that 2% difference rate. Now, the reason why interest rates are different between HECS and the mortgage rate is because they're calculated based on different metrics. Firstly, your home loan rate is based on 1 to 2% above the Reserve Bank cash rate. And this is because the banks can borrow from the Reserve Bank at, say, 3%, and then they will lend that out to you at 4.5 to 5%, and that is the margin that the banks make on lending you that money. Whereas HECS is based on one of 2 measures. Now, this changed following COVID and that nasty spike to 7.1%. The first measure is the Consumer Price Index. So historically, they've increased HECS by CPI, so the inflation rate. But when it spiked following COVID, they decided that they used 2 measures. So the second measure now is the Wage Price Index. And so whichever of those 2 is lowest is what they will calculate the HECS debt on. And this is calculated as of June 1st every single year. So 2 different measures means that your mortgage rate is going to be consistently higher than your HECS rate. So let's have a look at the second reason now, and that is how the repayments on your debt are calculated. So if we have a look at the mortgage payments here, you can see that the repayments are based on the interest rate you're being charged and the size of your mortgage. So the bigger your mortgage, the bigger your repayments. And the smaller your mortgage, potentially the smaller the repayments. So it makes sense that we would want to try and get our mortgage down so that those repayments become smaller, or at least the obligation becomes smaller. Whereas if we have a look at your HECS debt, it's completely different. Your HECS debt is based on the size of your income. So if we look at this table on the left-hand side here, you can see that if you earn less than $54,000, you don't actually have to pay back any HECS debt at that point in time. It's 0%. And if you never earn more than about that $54,000, now it does get indexed each year, but if you never earn more than that 54, you never end up paying back your HECS debt, and your HECS debt dies with you. It's not something that gets passed on to your kids. It dies with you. If we have a look at, say, $100,000 income here, you can see that 6% of your income is taken to pay your HECS debt as an extra tax each year. It does not matter if you have a $20,000 HECS debt or a $200,000 HECS debt. This is the amount that you will be charged. So it means that paying down more HECS doesn't actually help you from an income perspective or reduce your payments in any kind of way. Now let's have a look at reason number 3, and that is building equity. Every time that you pour more money into your home loan, you are building your equity in that home, which is the amount of your home that you own. So when you pay some money off your home, the amount you own gets bigger and the amount the bank owns gets smaller. this is basically an asset. So this asset can then be used, the equity can in theory be used to invest, it can be used to renovate, it could be used to upgrade to a bigger house or to buy an investment property. The equity is yours and you can use it however you like. So that is an asset. Whereas when you are paying off your HECS debt, you don't actually own anything. Your HECS debt is smaller, which is great, but it is not building up an asset. Your HECS debt is merely just a liability. And reason number 4 is a big one, and that is financial security. You will have so much greater peace of mind should some big life event happen, like losing your job, or maybe you get sick or injured and are unable to work, or maybe you need to take time off to care for a loved one. You're going to have much greater financial peace knowing that your mortgage is gone, or at least a lot smaller, than you will knowing that you paid off your HECS debt. And the reality is HECS debt is contingent based on your income. So if you do lose a job or if you are unable to work, then those HECS repayments stop anyway. Whereas our mortgage payment, they don't really care. Those mortgage payments just keep coming. You have to pay them no matter what. So certainly being able to get the home loan down or paid off is going to give you a much greater peace of mind. And the 5th and final reason is flexibility. This is the fun reason, because once we've got our home loan paid right down or paid off altogether, we have so much more disposable income that we can use to tackle big life goals. Now, one of those goals at that point might be to pay off your HECS debt. It might be to invest more or to put more into superannuation. It might be to take more holidays or more time off work. Whatever the reason, having your mortgage paid right down is going to give you that flexibility that paying off your HECS debt won't necessarily give you. Yes, paying off your HECS debt will free up your HECS repayments, but it's unlikely that those HECS repayments are anywhere near as big as what your mortgage payments are. Now, if this video has been helpful, can I encourage you to click the like button, because that helps my channel reach far more people. And please also subscribe, because every single week I'm releasing practical, life-changing financial education, because I truly believe that little habits and strategies you put in place today can literally make $1 million difference to your future. Okay, so let's summarize the 5 reasons why you might consider paying off your mortgage over and above your HECS debt. Reason number 1 is interest rates. We know that mortgage rates are typically 1.5% to 2% higher than the HECS indexation rate. Reason number 2 is repayment differences. So the way the repayments are worked out, the bigger your mortgage, the higher your repayments. Whereas with your HECS debt, it is based on your income. Doesn't matter whether your HECS debt is $20,000 or $200,000, the repayments are based on your income. Reason number 3, whenever you are paying extra money off your home loan, you are building equity in your home. So that means you own more of your home. This is an asset, whereas when you pay off your HECS debt, you're not building any equity, you're merely paying off a liability. Reason number 4 is financial security. You will have far greater peace of mind knowing that you've got your mortgage paid down than your HECS debt paid down should some big life event rob you of your income. And reason number 5, flexibility. Once you have your mortgage paid down or paid off altogether, it's going to significantly increase your disposable income, which you can then use however you like. It might be paying off your HECS debt, it might be taking a holiday, it could be any number of things, but the important thing is that you have the choice. You can choose how that money is going to be used. So I hope this has been helpful in your deliberations as to whether or not you should pay off your mortgage first or your HECS debt. If you have liked this video, please click the like, hit the subscribe button, and I look forward to seeing you in the next video.